Wednesday, August 31st, 2022, Monaco 64, home of alternative economics and contrarian views. So there's that old saying about kicking the can down the road, which basically means if you have a problem, instead of trying to solve that problem or overcome that problem, you just keep taking the easy way out, the shortcut, not really looking at the problem and trying to solve it. And unfortunately, I think that road, the end of that road, is very near for Britain, for the UK, for our currency. And I've been telling people for years, ever since, even before the 08 crisis, that the way the government was spending and growing would eventually lead to some kind of crisis, some kind of default, or inflation. Because that's what inflation is. When the currency drops so much, that's the government defaulting, because the existing debt becomes worth less and less in terms of real things. And that's how governments do it. Of course, it could lead to a normal default, like an individual would default, a bankruptcy. That's not out of the question. And it doesn't please me to talk about these things. And I'm no prophet as well. The only reason I could see this coming is that when people act in a certain way, there will be consequences to the way they act. And as a nation, the UK, Britain, we have been living beyond our means for too long, and that's what we're going to look at today. So I definitely think the UK sovereign debt crisis could be imminent. I spoke about this back on August 19th this year, just a few weeks ago. So we're going to look again into that. Before I start, though, as for not being a prophet or even forecasting this, I'm going to reference this book here, The Triumph of Gold by Dr. Franz Pick. And in the introduction, a friend of his, Dr. Henry Jarecki, talks about this fact of forecasting, and he's speaking about Franz Pick. And I'll go over it. It says, Franz Pick, the world's foremost gold bug, is dead, a prolific writer and theoretician for the last 65 years. He died in the late 80s, He was, for 30 years, the publisher of the Black Market Yearbook, which, in deference to the respectability of his central banker clients, he renamed Pick's Currency Yearbook. He and I were friends from the time he directed me in 1967 to the bullion firm I now lead until his death last week. What I admired about him was not his predictive ability, but irascibility, energy, and rigid morality. True enough, he predicted, or said he did, the 1926 devaluation of the British franc, the 1931 devaluation of the British pound, and the meteoric rise in gold that emerged in the late 1960s. And here's the part I wanted to point out. But those predictions were not, when one knew him, predictions at all. They were rather the words of Hosea declaring that the children of Sodom and Gomorrah were behaving badly and would thus come to no good. They were not any more than Hosea's words were practical guideposts. Not at all. He knew no more about when gold or currencies would go up or down than anyone else can in this random world. So there you go. And I was warning people back in 2016 on this channel that they're going to have a lot of scapegoats for this deliberate inflationary policy. And what do I mean by deliberate? Well, Deliberate because the government has kept deficit spending. The central bank kept rates near zero, kept printing money. That's a deliberate inflationary policy. And in this case here, I said that Brexit would be used as a scapegoat. They found another scapegoat 2 years ago called COVID, and they're finding another scapegoat now in the name of President Putin and the Ukraine war. And I'm sure they're going to find another scapegoat as well for the current crisis, which has been brewing, I would say, even before the '08 crisis, but definitely has gotten worse since then because we had to bail out all the banks. We bailed out homeowners, people with large mortgages, because basically that was the flip side of bailing out the banks. We bailed out everyone again in 2020. We paid for them to stay at home and not work. And and we're bailing out energy companies now. We're talking about bailing out pubs. Pub companies are saying that the government has to bail them out now. So every Tom, Dick, and Harry wants the government to bail them out. And we all know that the government doesn't have any money. The money comes from the taxpayers, from us. So charts are always good to look at things, how they evolve, to give you an idea of what's really happening. And I've shown this chart many times. Back in 2016, when I was trying to warn people about this inflationary policy, you can see here that the pound was buying more than $2.10 back in just at the the kickoff of the '08 crisis. So there you go, $2.10. And I was warning in 2016 that it was going to get worse, that they were going to say that Brexit, they're going to use Brexit as a scapegoat. They've used other things. And this is inflationary policy here. And why is that? Well, because the dollar is still the reserve currency, and our currency is becoming worth less and less versus the reserve currency. We have to buy 100% probably of our imports in dollars. And that means we buy less. So we're almost had a 50% haircut. How could this have been avoided? Well, higher rates, no deficit spending by the government, balanced budgets, even surpluses. If not paying off the debt, not letting the national debt get bigger. But then that would have ruined their economic policy of inflationism. We wouldn't have had house prices go up so much. We wouldn't have saved the city of London. And people wouldn't have been able to take their cheap holidays 2-3 times a year since the '08 crisis. They wouldn't have been able to tell their friends, "Oh, I bought that house for $300. It's now worth $500. I'm gonna borrow more to buy this second or third car." And that's what it's about. And I'm seeing a lot of people out there on social media now coming out of the woodwork saying that this is a scam, that there's no crisis. But I'm sorry, this is payback time. And I'm going to show you a couple more charts. Before I do, though, as you see here, this trend line goes back to 1985 when the pound touched $1.05. That's the all-time low. And it looks like we're breaking this trend line. There's another trend line here coming from around the '08-09 crisis. I think that will be support. And it's just above 1 this year, or it's probably around 105. So if we break 105, it means things are really bad. I would expect the pound to hold that line, but we'll have to see. And I'll show you a longer term chart. And this goes back to the early 70s. And it just goes to show that long term, the pound is really in a secular bear market. The pound is getting debased more and more. Yes, we've had ups and downs, and I would say the pound was relatively strong from 1990 to 2008. so to speak. It was a pretty good period there. But as you see now, that 105 is only a matter of time, I think, and it could be either hit this year or next year. And as I said, if we break through that, it's a very serious thing. The other point I wanted to make, because I spoke about deficit spending, is to look at the deficits that we've had in this country. And this is for the last 25 years. And you can see that it was only in the late 90s and in 2000 where we ran small surpluses. But look at all the deficit spending we've had now. Look at 2020, 14.5% deficit spending, budget deficit to GDP. Look at even in 0809, we didn't get as much as that. But one important thing about this is that we've been promised by policymakers, by chancellors. And I remember vividly in 2010 when George Osborne became chancellor, when the conservatives and liberal Democrats were elected. He said that by 2015 we'd have a balanced budget, and here we are in almost 2023, and it's nowhere near. We're at supposedly -6 or 6% deficit here of GDP, and I think it will get worse. That 6%, and why? Well, because the economy is grinding to a halt. Government will probably help people out again. It's the only thing they know how to do. They've only really got two options: keep inflating and destroying the currency, or they could do the right thing, and that would be bad too. The right thing would be cutting government spending, running surpluses, Bank of England raising rates to 10, 12%, but then you'd have a complete collapse. So either way, unfortunately, it's the end of the road, as I said. And then I wanted to show you government spending as a percentage of GDP. And luckily enough, Wikipedia here has a historic set of data for that statistic. And you can see actually prior to World War I, it never was much above 10%, which was a good thing, smaller government. But in the last 100+ years, it's grown and grown and grown. And as you can see here now, we went from 36% in 2000. We're now above 50%, which means the government is bigger than the private sector. The government is crowding out the private sector. And that's the whole thing. We've been living beyond our means, and we expect too much of the government, and we forget that the government doesn't have any money. So it's now payback time, and that's why we have the current crisis. And it's not me now just saying this because some people might say, oh, you want to clickbait, you want to get views, but this came out last night when I was preparing the material for this video. Rishi Sunak warns of risk that markets lose faith in UK economy. So they're talking about the government bond yields and the falling currency. And I spoke about that on the 19th when I spoke about the UK sovereign debt crisis, or a default, that in the last 20 years or 15 years, every time the currency went down, they were able to keep bond yields under control, and now they're not. So, and I'll show you a chart here that proves that, and it's this one here. This is the 2-year gilt yield, and I think as I wrote here on this chart, the era of cheap and abundant credit is over. It's payback time. And it's very significant, and you can see we're almost at 3%. And this could go very quickly. It could match the sovereign debt crisis of 2012, when the pigs in Europe, Portugal, Italy, Ireland, Greece, and Spain had the same problem. Of course, they were in a single currency, but so the euro dropped as well. But their bond markets were an escape valve for investors. And I think, unfortunately, it's going to be an escape valve for investors here as well. Foreigners are losing faith in the economy, as Rishi Sunak said. And I think the only reason he's saying that is because he knows he's not going to be the prime minister, and so he can say those things. And if he was to become prime minister, I'm sure he wouldn't be talking about this. So, and I don't think Liz Truss is going to be a savior. She's just going to be put out there to try to minimize the mayhem that we're going to see. And what does rising yields like this mean? Well, it means that everything, all the cheap credit is being withdrawn. And it's not going to get better, and we are at the end of the road. So as Dr. Jarecki said there, I can't tell you the exact time all this is like going to happen, but we're in the middle of it now. And yes, hold on to your hats, batten down the hatches, I would say. And this is not just going to happen or is happening here in the UK. It's going to happen in Europe. It's going to happen in the United States. Basically everywhere around the world, I would say. So with that, let's quickly look at the markets this morning. It's 9:18, 8:18, sorry, it's 20 past 8 London time. We've got spot gold at $17.21. It's down about $3. High's been 26. The low has been 20. Silver is unchanged at 1842. High's been 56. Low 36. The Dow futures is up 170, 0.5%. Nasdaq 100 futures is up 0.75%, and the S&P is up 0.5% as well, just above 4,000. The FTSE is unchanged. The Euro Stoxx 50 is up 20 points. To the currencies, the pound is up slightly at 116.64. The euro is unchanged, just above 1. The dollar is down 0.25% versus the yen at 138.43. The dollar is unchanged versus the Swiss franc, 97.35. And the dollar is down 0.33% versus the yuan at 6.90. The dollar is up slightly versus the ruble at 60.25, but still stuck around that 60 level. Aussie dollar is up 0.5%, 68.90. The dollar is down 1/8% versus the Canadian dollar, 130.77, and the Kiwi dollar is up 1/3 at 61.45. To the general commodities, WTI crude is up 0.5% at 91.85. Brent is up 0.5% at 98.22. Notice a lot of volatility in oil here, but I would say the longer term trend is still higher. High-grade copper is up 1% at 3.59, and U.S. nat gas is up 1% as well at 9.15. Let's check the Dutch natural gas or European nat gas futures. That's up 4.3% at just under 280. And to finish off, let's quickly look at the bond markets. The 10-year gilt yield is at 272. So we're testing that 270 level I've spoken about. The 2-year yield is around 291. So it seems to be a little bit under control early on this morning. And to the Treasury market, the 10-year yield is unchanged at 310. The 2-year is at 346, both unchanged. So there you go. If you enjoyed this video, make sure you hit the like button. Please share far and wide. Think about subscribing to my channel if you haven't yet. And with that, I wish you all a great day. Take care. Bye.